This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. There's a pattern in the modern economy. The rich keep getting richer. Not sometimes, not occasionally, but consistently. This is not an accident. It is not luck. And it is not just hard work. It is structure. Today we break down why wealth naturally concentrates, how the system amplifies capital, and why understanding this changes how you play the game. Most people earn money through labor. They trade time for income. The wealthy earn money through capital. They own assets. Assets produce income whether they work or not. Stocks produce dividends. Real estate produces rent. Businesses produce profit. Bonds produce interest. Labor has limits. There are only so many hours in a day. Capital does not have that limit. Capital works 24 hours a day. That is the first structural advantage. Compounding is neutral, but it favors those who already have more. If you invest $1,000 at 8% annually, growth is modest. If you invest $1 million at 8%, growth is massive. Same percentage, different outcome. The system rewards scale. Wealth generates more wealth. This is exponential mathematics, not morality. Money creates access. Wealthy individuals invest in private equity, early-stage startups, exclusive real estate deals, tax-efficient structures. Most people never see these opportunities. Access changes return potential. Higher starting capital means access to high-quality investments, and better investments accelerate wealth. This is uncomfortable but real. Poverty is expensive. Lower-income individuals pay higher interest rates, have limited access to credit, face penalties and fees, cannot invest early. Wealth reduces costs. The rich borrow cheaper. They receive better financial advice. They optimize taxes legally. They reduce friction. Small advantages compound. When central banks lower interest rates and increase money supply, asset prices rise. Stocks rise. Real estate rises. Businesses rise. Who owns assets? The wealthy. When liquidity enters the system, it flows first into financial markets. Asset owners benefit. Wage earners benefit later, if at all. This creates widening gaps. Not because someone presses a button to make the rich richer, but because policy impacts asset prices. Most people use debt to consume. Wealthy individuals use debt to acquire assets. There is a difference. Debt for consumption decreases future flexibility. Debt for investment increases asset control. Wealthy individuals borrow at low rates. They leverage appreciating assets. They use other people's money strategically. The system rewards those who understand leverage. This is fundamental. Consumers spend. Owners earn. Most people aim to upgrade lifestyle. Wealthy individuals aim to upgrade ownership. Instead of buying luxury items, they acquire income-producing assets. Ownership creates cash flow. Cash flow creates reinvestment. Reinvestment creates exponential growth. Tax systems often favor capital gains over wage income. Long-term investments receive preferential treatment. Business owners deduct expenses. Real estate investors use depreciation. Employees pay taxes before spending. Owners often pay taxes after deductions. This is structural. Understanding tax structure changes strategy. Risk tolerance is different from risk capacity. A person living paycheck to paycheck cannot take large financial risks. One mistake could be devastating. A wealthy person can diversify. They can survive losses. They can think long-term. Time horizon is power. The longer you can hold assets, the more compounding works. Wealth buys patience. Patience builds more wealth. Money buys expertise. Financial advisors, tax strategists, investment analysts, legal counsel. Better information leads to better decisions. Better decisions lead to high returns. This advantage is often invisible, but it matters. Wealthy individuals interact with other wealthy individuals. Networks create opportunity. Opportunities create deal flow. Deal flow creates growth. Relationships are economic accelerators, and networks tend to concentrate. Inflation erodes cash, but it often inflates asset prices. If you own real estate or equities, inflation may increase your asset value. If you hold cash, purchasing power declines. Asset owners are positioned differently. The system protects ownership. High income alone does not guarantee wealth. The difference is allocation. Wealthy individuals invest surplus income. Many high earners increase lifestyle instead. The key difference is ownership accumulation. Wealth produces returns. Returns increase wealth. Increased wealth produces larger returns. This feedback loop continues. Meanwhile, those without capital must first build it. Building initial capital is the hardest stage. After that, compounding accelerates. That depends on perspective. The system rewards ownership, patience, and capital allocation. It does not automatically equalize outcomes. Understanding the system is more powerful than debating it. You cannot change the rules easily, but you can learn them. The rich get richer because they own assets. They use leverage strategically. They benefit from compounding. They access better opportunities. They optimize taxes. They think long term. This is structure, not conspiracy, not magic, mechanics. You do not need millions to start, but you must think like an owner. Acquire assets. Reinvest returns. Delay consumption. Increase financial literacy. Shift from earning only to owning. Because once ownership begins, compounding begins. And once compounding begins, momentum builds. The financial system amplifies capital. If you own assets, the system works for you. If you only trade time for money, the system moves slower. The goal is not resentment. The goal is alignment. Understand how money works. Position yourself accordingly. And let structure work in your favor.